Good afternoon, everyone. My name is Steve Meredith, and I'm the Business Finance Manager here at the Southwestern Pennsylvania Commission. And I'd like to welcome you to today's webinar entitled Small Business Financial Health, What It Is, and How to Build and Maintain a Financially Healthy Small Business. As every small business owner knows, running a small business is extremely hard work, and I think often small business owners concern themselves with one question: is my business profitable? And while that is the central question on any small business owner's mind, there are other items that business owners need to think about in order to have a complete understanding of their small business's financial health. The purpose of today's presentation is to highlight the items that small business owners need to consider in order to have a complete understanding of their business's financial footing. The reason why SPC is providing this information is because business owners must have a clear understanding of their business's finances in order to borrow from SPC. Now, one quick note, there is a lot of information contained in today's presentation, and I don't want you to feel like you have to feverishly take notes. This presentation is being recorded, and I will have our multimedia team post it on SPC's YouTube page after today's session. So you'll be able to go back to the YouTube link and view it at your leisure. I can also share that YouTube link with you via email once it is available. So you can always go back and watch the entire presentation again, or you can watch specific sections that you might need to review. Before we get into the main topic of the presentation, though, I would like to talk a little bit about what SPC is as an organization. We're a regional planning agency, we're a metropolitan planning organization, we're a local development district, and we're a core funded partner for, and fiscal agent for the Partnership for Regional Economic Performance, or the PREP program. Now, all of that might sound like alphabet soup, but from an economic development perspective, SPC is here to help the region's small businesses grow and prosper. So today, we really have three questions that we're trying to answer. First, what does it mean to have a financially healthy small business? How can you keep track of your business's financial health? And then what do you do if you find out if your business is not financially healthy? Things like, what do you do if your balance sheet doesn't balance? What do you do if your expenses are too high? Things of that such nature. We'll talk about some strategies about how to fix a financially unsound business and how to make it financially healthy. And then obviously we'll have a Q&A at the end. So let's jump right in. Defining small business financial health. Now, there are some common terms that I believe all small businesses should be aware of when you approach a conversation about your small business's financial health. First is liquidity. Liquidity is a company's available cash or cash equivalents. Okay? This is different from solvency. Solvency is having more assets than liabilities, or having the ability to pay your business's debts. Liquidity is essentially your business's ability to pay short-term obligations, whereas solvency is a business's capacity to meet its long-term financial commitments. And one of the lessons that I think a lot of small businesses learned from COVID-19 is that a lot of businesses might be liquid, but may not be solvent. And while small business owners might think that they're on solid financial footing, as long as they have enough liquidity or cash, the reality is that you need to be both liquid and solvent to have a financially sound business. Even if you have the short-term liquidity to operate, if something were to happen to your business like a global pandemic and you could not operate, how long could your business survive in a state of non-operation? So, in order to have a financially healthy small business, you need to have a complete understanding of the four items listed on the screen: income, expenses, cash flow, and current and long-term liabilities. Now, before we go any further on this slide, it's important to understand that essentially what we're talking about is a small business's books or financials. Now, all four of the bullets mentioned on the screen are equally important, but keep in mind, if math doesn't come easily to the person that owns the business, that's okay. I fully understand that small business owners don't go into business because they love spreadsheets. The only business owners that go into business because they love spreadsheets are probably CPAs, right? But most small businesses don't go. No, most small business owners, I should say, don't go into business because they love spreadsheets. Okay, and if you don't love spreadsheets and you don't love the financial aspect of the business, find somebody who is good at financials and who is good at math, and put them in charge of your company's books, or hire an accountant, hire a CPA. If you don't think you have the money for an accountant, a little later on in this presentation, I'll show you an example of some documents that can help you understand your expenses so that you know where to cut back in order to afford someone who can handle your books. Now, a keen understanding of income, expenses, cash flow, and current and long-term liabilities is required to have a full understanding of your business's financial health. But please note, especially with bullet point number 3, cash flow does not equal profit. We'll talk about that a little bit further in depth later, but cash flow does not equal profit. And finally, I put current and long-term liabilities on this list because, as you'll see later on in this presentation, they are two different types of liabilities, both of which are listed on your company's balance sheet. We'll dive further on into that topic a little bit later on in the presentation. So how do you track your business's financial health? Well, you need to maintain 3 separate documents: a profit and loss statement, also called the income statement, a cash flow statement, and a balance sheet. Now, the first thing that I would like to point out is that my opinion is, take it or leave it, again, this is just one man's opinion, is that as soon as your business can handle the expense, you retain the services of a CPA, or a certified public accountant. Whether a lender offers government-backed loans like SPC or they are a private lender, commercial lenders always prefer to see accountant-prepared financial statements when determining whether or not to lend to a small business. Now, one caveat to this advice is that business owners must be able to understand their business's financial health. Do not rely on your accountant to tell you whether or not your business is financially healthy. If you have to meet with your accountant once a month, or maybe once a quarter, or once every 6 months, do that. But make sure that as a business owner, you understand your business's financial health. Now, with that said, depending on the age of your business and where you are in the business life cycle, you may not be able to retain the services of a CPA right at the beginning, which means that you have to prepare the business financials yourself. It's important that you update the business financials on a regular basis, whether that be monthly, quarterly, or annually. And all 3 of these documents are of equal importance, so you want to keep all 3 of these documents up to date. Now, before we get into the sample business financial documents in the next 3 slides, I do want to point out that SPC, as with any other commercial lender for that matter, will want to see 3 years' worth of your company's business financials before they lend to you. If you haven't been in business for 3 years yet, they'll want to see whatever business financials you have, plus your company's business plan, and typically 3 years' worth of financial projections. So let's dive right into the first first statement, the sample profit and loss statement. Now, I like to start with a profit and loss or income statement because I think it's the easiest of the 3 financial statements to understand. Quite simply, you will be adding up your business's income for the reported period, the income at the top of the sheet here, okay? And the reporting period, again, can be monthly, quarterly, or annually. And then you'll subtract both your operating and non-operating expenses at the bottom of the sheet, shown here. And then the number at the bottom here is going to be your net income or net loss for the reported period. Okay, we're using the example company on the screen, they are operating, at a profit of $37,657.43. Now, let's say for the sake of argument that this fictitious business was operating at a loss. If it was operating at a loss, first of all, the expenses would exceed the total income, and that loss would be expressed in parentheses, okay? One quick note on non-operating expenses, very quickly, because I did mention that expenses include operating and non-operating expenses. These non-operating expenses are expenses that occur outside of a company's day-to-day activities. They can include monthly charges like interest payments on debt or unusual one-off costs. Let's give an example. An example of a non-operating expense would be if you have a bad storm and let's say you have fabric awnings above your business entrances, and because of some hail, those awnings ripped. The expense that you would incur to fix your awnings would be a non-operating expense. It would be a one-off expense, okay? And again, like I said, the final number at the bottom of the page here is your profit, or if it's a loss, it will be expressed in parentheses. Now, this document can help you understand the expenses that your business incurs and could help you cut back on certain expense areas in order to increase profits or perhaps make room for another more crucial expense, like retaining the services of a CPA. Now, from a lending perspective, SPC will want to see the past 3 years of your business's financial statements, including a profit and loss statement. Seeing annual profit and loss statements like the one shown can provide lenders with a good overview of your business's profits so that they can see how those profits have either grown or decreased over a period of time. And as the title suggests, this document can let you know whether or not your business is operating at a profit, or like I said, if your expenses exceed your income, it will tell you the severity of the loss at which your business is currently operating. Cash flow statement. Now, a cash flow statement summarizes the amount of cash or cash equivalents going into and out of a company. It tells the business owner how well the company generates the cash necessary to pay its debts and operating expenses. Now, it's important to note that the profit and loss statement and the cash flow statement are connected. The number at the bottom of the profit and loss sheet should be the number reflected as the net income on your cash flow statement. Now, unfortunately, when I was searching for good examples to show in this presentation online, I could not find an example of an income statement, a cash flow statement, and a balance sheet, all for the same fictitious company, right? So what I will show you here is, let's say for the sake of argument that the company that we were taking a look at was, we were taking a look at the income statement, the cash flow statement, and the balance sheet, all for the same company. If that was the case, then the number at the bottom of the profit and loss statement here would be the exact same number reflected as the net income on this line here. Unfortunately, like I said, I couldn't find an example where the two sheets matched up. But in reality, the number at the bottom of your profit and loss statement, reflected as the profit or loss, should be the net income number reflected at the top of your cash flow statement. Okay. Now, the main items that need to be shown on the cash flow statement are cash flows from operations, as you see at the top of the page here. Okay, those includes receipts from customers as well as disbursements to suppliers and employees. And then I do want to clarify one item on the cash flow from operations section. Okay, and that is the use of adjustments for depreciation in the example shown. Put simply, adjustments for depreciation. I'm highlighting the line here with the mouse. Okay. Put simply, depreciation is used to track the cost of a tangible asset over time. Now, there are several different types of depreciation methods that a company can use, but in this example, the amount of depreciation is being added to the net income after taxes. Okay, but in any event, you do need to adjust for the depreciation of the assets or the depreciation of equipment that you have in your business, okay? The other thing that you want to show on your cash flow statement is cash flows from investing. These are things like the purchase or sale of equipment, And then finally, cash flows from financing activities, taking long-term loans or paying dividends to owners. One quick note, any number that is shown in parentheses on a cash flow statement is subtracted, okay? So if you see here, cash flows from investing, you had cash receipts from the sale of property and equipment in this example. That was a positive $10,000. And then the business paid $12,000 for the purchase of equipment for a net cash flow of minus $2,000 in their cash flows from investing section. Okay. Now, as I previously mentioned, and I want to underscore here, okay, cash flow does not equal profit. For example, your business could turn a profit of $45,000 one month, but only see $17,000 of that in cash flow because the rest of it is pending in accounts receivable or cash into the business. You may have checks from a client that still need to be deposited into your business's account. That's why profit and cash flow are not interchangeable terms, okay? Additionally, you could make 30 to 40% profit on every product you sell, but that just means that you're selling those products for more than it costs to make them. At the end of the day, if your business's total debt exceeds the amount of money that flows in from operations, you will have negative cash flow, and that's an indicator that unless problems are fixed, the business could be in trouble, okay? Now this transitions into how SPC and other commercial lenders use this document. As a lender, we need to know if you have the cash flow to support not only your existing debt, but the new debt that you're taking on. This is sometimes referred to as the debt service coverage ratio, or DSCR, okay? Now DSCR is calculated by taking your net operating income, i.e. the very first number on the cash flow statement, right here. In this example, it's $79,000, okay? And dividing it by your debt service, or the sum of all of the debt obligations that your business has, the sum of all of the interest and principal that you will pay on all of your business debts, okay? A DSCR, a debt service coverage ratio of over 1, for example, maybe it's 1.68, means that you have more cash flowing into the business than debt owed. That's a great thing, okay? A cash flow of under 1, for example, 0.85, means that you have a higher amount of debt than cash flow into the business. This means that your business could be in deep financial trouble soon if adjustments aren't made, okay? So again, debt service coverage ratio of over 1 is good. A debt service coverage ratio of under 1, not so good. Indicator that changes need to be made, okay? Like I said, it's important to remember that banks use debt service coverage ratio to determine whether or not you can service not only your existing debt, but the new debt that you're about to take on. Balance sheet, okay? Now it's my opinion, and again, this is just my opinion, that a balance sheet is probably the most complex of the 3 financial documents that you have to maintain with your business. But I also think that it provides you with a good snapshot of your business's financial health for a given period of time, okay? A balance sheet is a statement of your business's assets, liabilities, and equity, okay? Assets can be defined as anything that the company owns that has value and can be used to meet debts or obligations. An example of some of the assets that are typically listed on a balance sheet can include, but are not limited to, cash on hand, the current balance of any business checking or savings accounts, accounts receivable, inventory, or the value of any fixed assets that a company owns. For example, land or equipment, okay? Liabilities, on the other hand, are debts or financial obligations for which the business is responsible, and they are broken down into current or non-current or long-term liabilities. So current and non-current or long-term liabilities, Okay? Current liabilities are those that are to be settled in cash within the fiscal year or operating cycle of a given company. These are things like accounts payable, payroll liabilities, taxes payable, or current portion of long-term debt, CPLTD. CPLTD, the current portion of long-term debt, is the portion of a long-term liability that is coming due within a company's current fiscal year or operating period. For example, if your business took an EIDL loan, given the fact that we've just come through COVID or we're getting through COVID, let's use EIDL as the example. The term of that loan, of that EIDL loan, could be up to 30 years in length. The current portion of long-term debt on that 30-year EIDL note represents only the amount of money that you will pay during your company's current fiscal year or operating cycle. By contrast, non-current liabilities are listed in a separate section on the liabilities side of the balance sheet. Non-current or long-term liabilities are a company's financial obligations which are due more than 1 year in the future. These are things like your business's mortgage loan principal, or perhaps the portion of the 30-year EIDL loan that is coming due after the current fiscal year ends. Now you might be thinking to yourself, well, Steve, that's really confusing. Like, how can I have a 30-year loan? How can that be both a current and long-term liability? Why do you separate it out like that? This is because the payments on a long-term debt that are coming due during your company's current fiscal year need to be paid with liquid assets like cash, okay? On your company's balance sheet, the reason you separate current payments on longer-term debt from the rest of the debt owed over time is because you will need to have the cash flow now to make the payments that are due this month and the payments that are due in the forthcoming months on your business's current in your business's current fiscal year, okay? So you need to splice it out and say, okay, how much money am I going to pay on my EIDL loan in the next 12 months? Because I need to have the cash flow now to meet that debt obligation. And then anything else that is coming due after the next 12 months or after the operating period, we can worry about after the operating period, okay? Finally, equity is listed in the right-hand column of your business's balance sheet immediately following your business's listed liabilities, and it represents the difference between your business's assets minus its liabilities. The equity section of a balance sheet should show the business's retained earnings or the amount of money that the business has left after it has paid out dividends to the owners. Finally, the equity section should show any deposits or withdrawals that any of the owners make in the reported period. At the end of the day, as the title suggests, the amounts on the left-hand side and the right-hand side should match or be the same. They should balance. If the two columns do not balance, then you have what is known as an unbalanced balance sheet. Now, there are 4 main reasons why a balance sheet doesn't balance. You could forget to include transactions or include the same transaction twice. You could record transactions incorrectly. Transposition errors happen all the time. Sometimes you record an expense as a $37 expense when it's actually a $73 expense. Happens all the time. Misclassification of data. Remember, assets add value to your company. Liabilities are obligations that you are in charge of paying, that your business is in charge of paying. And then finally, not recording inventory changes. The one example that I can use from personal finances, when I was a young college kid, when I was fresh out of college, actually no, when I was more heading into college, and I had my first bank account, I had my first checkbook. I would always tear my hair out every month trying to balance my checkbook because I would inevitably record a transaction incorrectly in my check register. Okay, that's the same kind of thing that can happen with a business's balance sheet. These things happen. Don't beat yourself up too much about it. Just the remedies are rather simple. Okay. First, you can conduct a trial balance before creating a balance sheet. Okay. This document lists all of the company's debits and credits, and it can either be done manually or be done using your business's computer accounting system. Okay. Second, almost goes without saying, just stay organized. All right. Review the transactions regularly, pinpoint and remedy problems quickly. Okay. Once again, my advice, take it or leave it, would be to retain the services of a CPA as soon as your business can afford the expense. But at the same time, the business owner needs to understand the common issues that can cause an unbalanced balance sheet. By having this understanding, you'll have more success when working with your CPA to remedy any issues that may arise on your balance sheet. Curing a financially ailing small business. Okay, this is really a common sense slide. Okay, there are three main ways that you can cure a financially ailing small business, and that's to hustle and sell more goods and services, reduce expenses, and pay down debt. It almost goes without saying, but by maintaining the three aforementioned documents that we talked about today, you will have a better handle on the actions that you need to take in order to have to put your business on the path to financial success. Okay. Now, with regard to expenses, this is why a profit and loss statement is so crucial. You need to see what your expenses are costing you on a month-to-month basis, what they're costing your business on a month-to-month basis, so that you can make the necessary adjustments to increase profits, decrease those expenses, or account for an additional expense that your business needs to pay, like an accountant to handle your books. Putting your business on solid financial footing requires you to work hard to sell additional goods and services, but it also requires you to work smart and take an active role in keeping track of your business's finances. You want to reduce your expenses to the point where the expenses that you're incurring are crucial to your business's operation and growth. You must be concerned with the return on investment that your business receives for each expense incurred. Okay? Now, in terms of where to get help, I would strongly encourage you to utilize the network of assistance organizations listed on the screen. First up is the Small Business Development Center Network. This is, in my opinion, an absolutely crucial partner for your small business, okay? If you own a startup and you come to me for a small business loan, the first question out of my mouth will be, do you have a business plan and do you have financial projections, okay? This is for startups. Even if the answer is yes, I will ask if that plan and projections has been reviewed by an SBDC. If not, your business plan and projections will need to be reviewed by an SBDC before we can lend to you. And I will be happy to refer you to any one of the outstanding SBDCs that we have in the region. We have a plethora of them. We've got the University of Pittsburgh SBDC. We have the Duquesne University of SBDC. We have the St. Vincent College SBDC. We have the Clarion University SBDC. All great entities, okay? I typically refer small businesses that are in need of those kinds of assistance, business planning assistance and projection assistance. What I typically do is I refer those small businesses to an SBDC, and then I set a reminder in my calendar about 4 to 6 weeks later to see how the business plan and projections are coming along. And then once that business plan, those projections are complete, then we can take the next steps in financing your business's acquisition, purchase. Maybe it's a building acquisition, maybe it's an equipment purchase, whatever the case may be. Okay. The Service Corps of Retired Executives, or SCORE. This is another fantastic resource if you're a new small business owner seeking advice. SCORE is a team of professionals that have been in a business owner's shoes and have quote-unquote walked the walk. Okay, the advice provided by SCORE mentors is free of charge, and again, I'd be happy to put you in contact with them. For women-owned small businesses, the Chatham University Center for Women-Owned Entrepreneurship, they have been in the area, in the region, serving women-owned businesses for 15 years, and they do an absolutely outstanding job. Okay, so I can connect you with Chatham University if you are a women-owned small business. Quick note on veteran-owned small businesses. I put the University of Maryland Veterans Business Outreach Center. That is an SBA affiliate. It's a VBOC for short. The University of Maryland VBOC is responsible for veteran-owned businesses in Pennsylvania, Maryland, Delaware, and Washington, D.C. So I recognize that College Park, Maryland is not exactly a stone's throw from Pittsburgh or the southwestern Pennsylvania region, but the University of Maryland VBOC is the VBOC that is responsible for assisting veteran-owned businesses in Pennsylvania. And then finally, I did put the Southwestern Pennsylvania Commission because we do provide financing support to small businesses, and we'd be happy to discuss any financing projects that you might have. So with that wraps up my portion of the presentation. There is my contact information. If you have questions and you'd like me to answer them live, please feel free to either put them in the chat box, or if you have a microphone, you can unmute yourself and ask questions of me here today. That way. If you feel more comfortable asking questions offline, there's my contact information. SPC has recently instated a new work policy where we're in the office 3 days a week and then working from home 2 days a week. So my schedule right now and for the foreseeable future is going to be Monday, Tuesday, Wednesday, I will be in the office, and then Thursday and Friday I'll be working from home. You can always reach me via email if that's easier for you. I also wanted to let everyone know that SPC has a brand new online loan application portal which features a pre-application questionnaire. This questionnaire will help you quickly understand your business's eligibility for SPC financing. Once you arrive at the link listed on the screen, you will be asked to sign up for a free account, and then you will be able to complete the pre-application questionnaire. If after completing the questionnaire it appears that you are eligible for SPC financing, SPC's business finance staff will reach out to you within 72 hours to discuss your project, and depending on your eligibility, you may be able to complete SPC's loan application entirely online. Okay? Finally, I always invite attendees to connect with me on LinkedIn, as I enjoy meeting new small businesses via that social network and facilitating conversation that way. So I'm actually going to turn my video on right now and show that there's a face behind the curtain. If you have any questions, like I said, please feel free to enter them into the chat, or feel free to unmute yourself and ask your questions that way as well. Give a couple minutes for anybody that might have questions, and I thank you again for attending today. This webinar came out of a lot of discussions that I had with small businesses. A lot of the holes that I saw in some of the understanding of what was needed in terms of business financials. Sometimes we'll talk to small businesses and we'll say, hey, do you have business financials? Do you have tax returns and things like that? And they'll have the individual tax returns, but they won't have the business tax returns, or they won't have the business financials. So, one of the things when I developed this curriculum, when I developed this slideshow today, was I wanted to underscore the importance of having these business financials because it's really important for any small business to have them, so that you can have not only a firm grasp of your business's financial footing, but it's really meant to give you peace of mind as a business owner to know, whether your business is profitable, how profitable is it, how dangerous or how close are you to not necessarily being profitable? What's your debt service coverage like? Do you have the appropriate amount of cash flow coming into the business to service that debt? All of these topics covered today, I think, are crucial for small business owners to understand. And I think a lot of times what happens is business owners go into business because they're passionate about their product or they're passionate about their service. I'm not saying that you shouldn't be passionate about your product or service, but I do think that you do need to have a little bit of a sense of understanding of the paper behind the business, the paperwork behind the business that you own. So with that, I will step off my soapbox, and I hope that this was helpful to those that were here live today. If you are watching this on demand, please feel free to reach out to me if you have any questions. If you're interested in financing, again, please feel free to take that pre-application questionnaire that the link that we showed on the screen. And again, please feel free to connect with me on LinkedIn. Thank you once again, and with nothing further, have a great afternoon. Thanks.